This movie isn't about money, but if you own even one XRP, it could be one of the most important things you watch this week. And that's not hype. Because while everyone is distracted by Bitcoin headlines and Ethereum gas fees, something far bigger is quietly happening underneath the surface of the financial system. It doesn't trend on Twitter. It doesn't rely on memes. It doesn't need hype cycles. It's called XRP, and it was never built to impress retail traders. It was built to work. And that's the first thing most people miss. Bitcoin is brilliant as a store of value. Ethereum changed what smart contracts could be. But XRP was designed for a completely different role, not as a speculative toy, not as a digital collectible. XRP was engineered as infrastructure, the kind of infrastructure that global finance actually needs, the kind that banks, institutions, and governments can plug into without rewriting the entire system. That's why the Ripple team doesn't look like a typical crypto startup. These aren't hoodie-wearing developers chasing hype. These are professionals who operate more like investment bankers and financial engineers. Many of them come straight from Wall Street, Ivy League institutions, and legacy finance. They understand compliance, they understand regulation, and most importantly, they understand how money actually moves at scale. Ripple isn't trying to replace the financial system overnight. They're upgrading it quietly, piece by piece. Now, pause here for a moment because this is where positioning matters more than timing. Public markets price XRP as if it's still early stage. Private institutions are valuing it very differently based on utility, flow, and long-term integration. This is where the insiders separate from the crowd. Private XRP valuations far exceed public prices. Inside Crypto Insider's Elite, members get exclusive weekly alerts, top 1% positioning, millionaire mindset training, and private price models revealed inside. It's in the pinned comment. And this distinction, public perception versus private positioning, is critical because markets don't move when everyone agrees. They move when reality catches up to what insiders already understand. Ripple understands that the next phase of crypto isn't memes or speculation. It's tokenized real-world assets, stable coins replacing dollars, treasury bills moving on-chain, stocks, bonds, and real estate settling digitally instantly across borders. Think about how money moves today. Cross-border payments are slow, expensive, and fragmented. Banks rely on outdated correspondent banking networks that can take days to settle and cost a fortune in fees. Capital gets trapped in Nostro and Vostro accounts around the world, sitting idle just so institutions can settle transactions. It's inefficient by design. XRP solves that. XRP acts like a bridge asset. It allows value to move from one currency to another in seconds at a cost of less than a penny. No pre-funded accounts, no waiting days for settlement, no layers of intermediaries taking a cut, just instant liquidity on demand. That's why XRP isn't just another coin. It's a link, a rail, a neutral asset that doesn't belong to any one country or central bank, yet can connect all of them. And here's where things get interesting. While retail investors argue online about price targets, major institutions are positioning quietly. 11 major financial players representing over $240 billion in assets have formally filed to launch an XRP ETF. Let that sink in. This isn't rumor. This isn't speculation. These are regulated institutions asking the SEC for permission to give Wall Street direct exposure to XRP. We've already seen what happens when that door opens. When Bitcoin's ETF was approved, institutions didn't tiptoe in. They flooded the market. Billions of dollars flowed into Bitcoin in a matter of weeks. Liquidity exploded, volatility changed. The entire narrative shifted from risky experiment to institutional-grade asset. Now ask yourself an honest question. What happens if XRP gets that same green light? Because unlike Bitcoin, XRP already has a defined use case tied directly to global payment flows. It's not waiting to become useful someday. It's already being used. Banks, payment providers, and financial institutions are actively integrating Ripple's technology into real-world systems. And this isn't theory. Ripple holds over 60 regulatory licenses across the globe. They've spent years working with regulators instead of fighting them. They didn't run from oversight. They embraced it. That's why when the SEC lawsuit finally ended, Ripple didn't just survive. They emerged stronger, clearer, and more legitimate than ever. That legal clarity changed everything. For years, XRP was dismissed. Critics called it centralized. Skeptics questioned its future. But while the noise was loud, Ripple kept building. They kept shipping products. They kept signing partnerships. They kept laying the groundwork for something much bigger than price charts. And now the pieces are coming together. One of the most overlooked developments right now is Ripple's stablecoin RLUSD. It launched quietly, without hype, without marketing theatrics. And yet in just 6 months, RLUSD grew from zero to over $500 million in market capitalization. That's not normal growth. That's institutional adoption. RLUSD didn't just climb the rankings. It jumped from the 36th largest stablecoin to the 17th in record time. It's now one of the fastest growing stablecoins in the world, second only to BlackRock CK's USDTB. Think about that for a moment. Ripple is competing directly with BlackRock CK and PayPal in the stablecoin race. That alone should make people pay attention. But what really matters isn't just RLUSD's growth. It's how RLUSD interacts with XRP. On the XRP ledger, XRP is the native asset. That means when assets are exchanged, XRP is often used as the bridge to route liquidity efficiently. This process is called auto-bridging. Every time RLUSD is traded on XRP PPL, XRP facilitates that transaction, and every transaction burns a small amount of XRP permanently. This is where supply dynamics come into play. Unlike many cryptocurrencies with inflationary models, XRP's supply slowly decreases over time as usage increases. More transactions mean more burns. More burns mean less supply. Less supply, combined with growing institutional demand, creates upward pressure on price. And here's the part most people aren't pricing in. Right now, about 83% of RLUSD activity happens on Ethereum, not the XRP ledger. Why? Familiarity. Developers and users default to what they know. Ethereum feels safe. It's where most stablecoin activity already lives, but it's also slower and far more expensive. As RLUSD adoption grows, cost efficiency will matter, speed will matter, settlement certainty will matter. And when that shift happens, when RLUSD volume migrates more heavily to XRPL, the burn rate for XRP accelerates dramatically. That's the hidden lever. XRP doesn't need hype-driven demand to rise. It needs usage, and usage is growing quietly, systematically, and globally. Meanwhile, the broader crypto market is setting the stage. Bitcoin continues to attract institutional capital. Analysts like Mike McClough and Tom Lee have openly discussed Bitcoin reaching $150,000, $200,000, even $300,000 in this cycle. If that happens, capital doesn't stop at Bitcoin. It flows outward into infrastructure plays with real utility. Ethereum may double or triple, but assets with genuine product market fit. Assets tied directly to real-world financial flows often outperform during that phase. XRP sits squarely in that category. At today's prices, XRP is still being valued like a speculative altcoin, but its role is closer to financial plumbing. And plumbing doesn't need to be exciting. It needs to be everywhere. The global stablecoin market sits around $250 billion today. Over the next few years, that number is expected to grow to $1 to $2 trillion. That growth won't be evenly distributed. It will concentrate around platforms that can handle scale, regulation, and interoperability. Ripple has been preparing for this for years. They didn't rush Arlusty. They waited until the regulatory framework was clearer. They integrated it directly into their existing payment infrastructure, and they aligned it with XRP's role as a bridge asset rather than a competitor. That's a strategic move, not an accident. As stablecoin volume grows, as real-world assets move on-chain, as institutions demand faster and cheaper settlement, XRP's relevance increases, not because of speculation, because of necessity. And that's why the ETF matters so much. An XRP ETF isn't just a price catalyst, it's a signal. It tells Wall Street that XRP is acceptable, that it's investable, that it belongs in portfolios designed for global finance exposure. And once that door opens, demand doesn't trickle in, it rushes, especially when the asset in question is still priced under double digits. And as this institutional layer builds, something else happens quietly in the background. Wallets increase, transaction volume rises, burn accelerates, and supply tightens. Not overnight, but steadily, mechanically, inevitably. This is how infrastructure assets reprick. Slowly at first, then all at once. And that's why understanding XRP today isn't about predicting a moonshot. It's about recognizing a structural shift in how value moves around the world and who controls the rails it moves on. When you zoom out and look at how markets actually reprick infrastructure, you start to see why XRP behaves differently than most cryptocurrencies. This isn't a narrative driven asset that pumps. It's a utility driven asset that moves when usage, liquidity, and institutional confidence reach critical mass. And that process is already underway. Most people still analyze XRP using the wrong framework. They compare it to meme coins or even to Bitcoin, asking questions like, can it go 10x? Or is it too centralized? But that misses the point entirely. XRP is closer to a financial protocol than a speculative token. Its value comes from how much capital flows through it, not how many people tweet about it. Think about Visa for a moment. Visa doesn't hold your money, it doesn't speculate, it facilitates transactions. And because trillions of dollars move through Visa's rails every year, the company itself is incredibly valuable. XRP is aiming to play a similar role, but on a global asset agnostic level without being tied to any single country or currency. That distinction matters more than most people realize. Right now, trillions of dollars move across borders every single day. Foreign exchange markets alone clear over 7 trillion daily. Most of that activity still relies on systems built decades ago. Slow settlement, high friction, counterparty risk, capital locked up unnecessarily. XRP was built specifically to solve that inefficiency. And unlike many crypto projects, Ripple didn't try to force adoption from the bottom up. They went straight to the top. Banks, payment providers, central banks, regulators. That approach takes longer, but when it works, it scales far faster and lasts far longer. This is why regulatory clarity was such a big turning point. For years, the SEC lawsuit acted like a ceiling over XRP's price and perception. Institutions stayed cautious, funds stayed on the sidelines, but behind the scenes, Ripple continued expanding internationally. They secured licenses. They integrated with financial institutions outside the US. They tested real-world corridors where XRP actually moves value today. When that legal cloud lifted, it didn't just remove risk, it unlocked demand. Now institutions can engage without fear of retroactive enforcement. ETF issuers can file. Asset managers can model XRP into long-term strategies. And that's exactly what we're seeing now. Multiple ETF filings, increasing institutional commentary, quiet accumulation, rather than loud speculation. And here's where the pricing conversation becomes grounded in reality instead of hype. At current levels, XRP is still priced as if it's optional, as if it might be useful someday. But the truth is, it's already useful. It's already live and it's already integrated into systems that move real money. When Bitcoin ETFs launched, billions flowed in within weeks. That wasn't because Bitcoin suddenly changed, it was because access changed. XRP faces a similar dynamic, but with an important difference. XRP supply dynamics are fundamentally tighter over time due to burn mechanics tied to usage. Every transaction on the XRP ledger destroys a small amount of XRP. That burn is tiny on a per transaction basis, but massive at scale. As transaction volume increases, the burn accelerates. And because XRP has a fixed maximum supply, every burn permanently reduces the total available. Now layer RLUSD on top of that. RLUSD isn't just another stable coin competing for attention. It's a strategic tool. Ripple understands that stable coins are the on-ramp for institutions entering on-chain finance. They're predictable, they're compliant, they're easy to account for, and they move fast. But unlike most stable coins, RLUSD is designed to reinforce XRP's role, not replace it. On the XRP ledger, XRP often acts as the intermediary asset during trades. That means when RLUSD is exchanged for another asset, XRP facilitates that transaction through auto-bridging. Each of those interactions increases XRP's utility and contributes to burn. The key variable here is where RLUSD volume lives. As of now, the majority of RLUSD activity is still happening on Ethereum. That's not because Ethereum is better, it's because habits are hard to change. Developers default to Ethereum because it's familiar. Liquidity is already there. But Ethereum comes with congestion, higher fees, and slower settlement. As RLUSD scales, those inefficiencies become more painful. Businesses don't care about ideology. They care about cost, speed, and reliability. When the economics make sense, volume migrates. And when that migration happens toward XRPL, the impact on XRP is nonlinear. More RLUSD volume on XRPPL means more transactions. More transactions mean more auto-bridging. More auto-bridging means more XRP burned. And more XRP burned means tighter supply, just as institutional demand ramps up through ETFs and direct integration. That's not speculation, that's math. This is also why comparing XRP's price to Bitcoin's price directly misses the point. Bitcoin's value comes primarily from scarcity and narrative as digital gold. XRP's value comes from velocity, flow, and integration into financial systems. It doesn't need to match Bitcoin's market cap to deliver significant price appreciation. Now consider the broader market context. If Bitcoin reaches $150,000 this cycle, as many analysts expect, the total crypto market cap expands dramatically. Historically, once Bitcoin establishes a clear top range, capital rotates into assets with strong fundamentals and real-world use cases. That's when infrastructure tokens tend to outperform. Ethereum could see a 2x or 3x, but assets tied directly to payments, settlement, and institutional rails often see outsized moves because they're repriced based on utility rather than speculation. Under a $150,000 Bitcoin scenario, an XRP price around $5 isn't aggressive, it's conservative. At $250,000 Bitcoin, XRP moving toward 8 to 9 becomes entirely reasonable, especially if an ETF is live and RLUSD adoption continues accelerating. And remember, those numbers don't assume global domination overnight. They assume steady integration, growing transaction volume, and normal market conditions. Another factor that's often overlooked is wallet growth. XRP now has over 6 million wallets. That number continues to rise steadily, not in spikes driven by hype, but through consistent adoption. That's a sign of organic growth. It suggests users are actually holding and using XRP, not just flipping it. Meanwhile, institutional sentiment is shifting. Projects that were once dismissed are being reevaluated. Even critics who previously avoided XRP have acknowledged that Ripple's persistence, regulatory wins, and continued development change the risk profile entirely. That matters because capital follows legitimacy. Wall Street doesn't chase memes. It chases clarity, scale, and compliance. XRP now checks all three boxes. And here's another subtle but important point. XRP doesn't need to replace Bitcoin or Ethereum to win. It occupies a different lane. Bitcoin stores value. Ethereum executes logic. XRP moves value. Those roles are complementary, not competitive. In a world where trillions of dollars in assets are tokenized, settlement speed and liquidity become critical. Stablecoins will dominate payments. Tokenized treasuries will dominate yield. Tokenized securities will dominate capital markets. All of that needs rails. Ripple's technology is designed to be those rails. This is why governments are warming up. This is why institutions are filing ETFs. This is why Ripple continues to secure licenses globally. And this is why XRP keeps showing up quietly in conversations that actually matter. The market hasn't fully priced this in yet, but markets always catch up to reality eventually as more RLUSD volume shifts to XRPPL, as ETF demand materializes, as transaction volume rises, and as supply continues to shrink through burn, XRP's valuation framework changes. It stops being treated like a speculative altcoin and starts being valued like financial infrastructure. And infrastructure doesn't move in small increments once adoption reaches critical mass. The pieces are already on the board. The only thing left is execution. And Ripple has spent years proving that execution is exactly what they do best. As this transition accelerates, the next layer to understand is how institutions position themselves ahead of these shifts, how supply shock dynamics actually play out, and why timing matters far less than positioning when infrastructure assets finally reprick. Once you understand that XRP is being positioned as infrastructure, the final piece of the puzzle becomes clear. How supply shock actually forms, how institutions front or run that reality, and why the public almost always notices last. This isn't unique to crypto. It happens in every major technological shift. The people closest to the system move first. Everyone else reacts later. Institutions don't wait for headlines. They don't wait for retail excitement. They move when risk is removed and when upside becomes asymmetric. That's exactly the environment XRP is entering now. For years, XRP carried regulatory risk. That alone kept trillions of dollars of institutional capital on the sidelines. not because the technology didn't work, but because compliance departments couldn't touch it. That chapter is closed. Ripple didn't just survive the SEC battle, they won clarity. And clarity is the most valuable asset in finance. With that clarity, XRP becomes modelable. Funds can now run long-term scenarios. ETF issuers can structure products. Banks can integrate without legal uncertainty. That's when supply shock begins. Not with price spikes, but with quiet accumulation. This is how it usually starts. Volume increases without dramatic price movement. Wallets grow, liquidity thins. Then one day, demand overwhelms available supply, and the repricing happens faster than most people expect. XRP is uniquely positioned for this because its supply dynamics are misunderstood. Yes, the maximum supply number looks large at first glance, but circulating supply is what matters, and circulating supply is constantly tightening through burn, long-term holding, and institutional custody. Every transaction on the XRP ledger burns XRP permanently. It's not dramatic on a daily chart, but over time it compounds. And as usage increases through payments, stable coins, and tokenized assets, the burn accelerates naturally. This is where our ALUSD becomes the catalyst most people are overlooking. Stable coins are the gateway drug of on-chain finance. Institutions don't move volatile assets first. They move stable value. RLUSD gives them a regulated Ripple native option that integrates directly into an ecosystem built for speed and compliance. As RLUSD grows, it drives transaction volume. As transaction volume grows, XRP is used more frequently as a bridge. As bridging increases, XRP is burned. As burn increases, effective supply shrinks. Now combine that with ETF demand. An ETF doesn't care about ideology, it cares about access and liquidity. Once an XRP ETF is approved, large pools of capital gain exposure instantly. Pension funds, registered investment advisors, institutions that can't self-custody crypto suddenly can participate. And here's the critical difference between XRP and Bitcoin in that scenario. Bitcoin's supply is fixed but not shrinking. XRP's supply is actively decreasing with usage. That creates a unique dynamic where increased adoption directly reinforces scarcity. At the same time, Ripple's global footprint continues expanding. More licenses, more corridors, more integrations, more governments exploring digital settlement rails. This isn't theoretical adoption, it's operational adoption. This is also why XRP doesn't need retail hype to succeed. Retail attention usually arrives after infrastructure is already in place. By the time mainstream narratives shift, the easy positioning is gone. You've seen this pattern before. Early internet infrastructure companies weren't exciting to the public. The excitement came later, once everyone realized how dependent the world had become on them. Payment rails work the same way. Nobody cares how value moves until it stops moving efficiently. That's the problem XRP solves. Now let's ground this in realistic pricing frameworks, not fantasy numbers. If Bitcoin reaches $150,000 this cycle, as many analysts expect, total crypto market liquidity expands significantly. In that environment, infrastructure assets with real-world utility tend to outperform speculative assets because they attract institutional capital, not just retail flows. Under those conditions, XRP moving into the $5 range is not extreme. It aligns with historical altcoin rotations, current adoption trends, and improving supply dynamics. If Bitcoin pushes toward $250,000, XRP reaching $8 to $9 becomes increasingly plausible. These aren't moonshot predictions. They're scenario-based valuations grounded in usage, demand, and market structure. And importantly, they don't assume XRP becomes the only payment system in the world. They assume it becomes one of the dominant ones. That's a much lower bar and still incredibly valuable. Another misconception is that XRP must be liked by the crypto community to succeed. It doesn't. It needs to be used, and usage is driven by institutions. The fact that XRP was once unpopular may actually be its greatest advantage. It allowed Ripple to build without distraction, to focus on compliance instead of clout, to integrate with regulators instead of fighting them. Now that the tide is turning, even former critics are reassessing. Projects that survive adversity and continue shipping tend to earn long-term trust. Ripple did exactly that. Meanwhile, the broader financial system is undergoing a massive shift. Tokenization of real-world assets is accelerating. Stablecoins are replacing traditional settlement in many corridors. Governments are exploring digital currencies, and financial institutions are racing to modernize before they're left behind. All of this points in the same direction: faster, cheaper, interoperable value transfer. XRP was built for that world. It's not flashy, it's not loud, it doesn't promise overnight riches, it promises efficiency, and efficiency always wins in the long run. This is why XRP doesn't need to catch up to anything. It's playing a different game on a different timeline. While others chase narratives, Ripple is embedding itself into the financial plumbing of the next decade. This is not financial advice. When that realization spreads, repricing happens quickly. The people who benefit most aren't the ones who buy tops. They're the ones who positioned early, understood the system, and stayed patient while infrastructure matured. That's the real opportunity here. Not a gamble, not a meme, a calculated position in a system designed to move trillions. So, when you hear debates about whether XRP feels crypto enough, remember this: value doesn't move to what feels good, it moves to what works. And XRP works. It works within regulation, it works across borders, it works at scale, and it works right now. The question isn't whether XRP will play a role in the future of finance. It already is. The question is whether you recognize that before or after the market fully prices it in. Because by the time the narrative flips, the easy gains are gone. What remains is utility-driven appreciation, and that favors those who understood the system early. If you followed this entire breakdown, you now see what most people don't. XRP isn't a bet on hype. It's a position on infrastructure adoption and the inevitable modernization of global finance. And moments like this, when clarity meets undervaluation, are rare. If you want private XRP insights, insider price models not shown publicly, weekly elite alerts, and strategies the top 1% use to build generational wealth, join Crypto Insiders Elite.